When we think about Switzerland and gold, a lot of preconceived or even romanticized ideas come to mind. We picture vaults, secrecy, and an almost mythical sense of stability. But the reality is even more interesting. Switzerland's gold reserves are managed as a modern, strategic tool. Today, we're going to walk through the facts that explain why this gold stock still carries weight, both in public trust and in the future. Stay until the end. You'll even see how gold can distort certain Swiss economic statistics. Fact number 1. The Swiss National Bank holds 1,040 tons of gold, a level that has remained unchanged for several years. That's not a trivial detail. This kind of stability signals a long-term strategy, not an emotional reaction to market swings. The next question is obvious. Where is all that gold stored? For security reasons, the exact locations aren't disclosed publicly, but the Swiss National Bank states that around 70% is stored in Switzerland, with about 20% at the Bank of England and around 10% at the Bank of Canada. And beyond the central bank's reserves, Switzerland remains a major global hub for gold refining and trade. A recent benchmark attributes 34% of the world's refined gold in 2023 to Switzerland. Yes, you heard that perfectly. 1/3 of the world's refined gold. Fact number 2. Even if the quantity of gold reserves doesn't move, their value can swing sharply with the price of gold. At the end of 2024, the Swiss National Bank's gold holdings were valued at around 79 billion Swiss francs. In other words, you can hold the same stock and still see a balance sheet that looks radically different from one year to the next. Fact number 3. The central bank explains that it is required to hold part of its reserves in gold, and that gold also helps diversify its investment portfolio. In other words, gold isn't just a cultural symbol. It's built into a strategy of resilience. Fact number 4. The geographical distribution is explicitly documented. Roughly 70% of the gold is stored in Switzerland, 20% in London at the Bank of England, and 10% in Canada at the Bank of Canada. This setup combines security, regional diversification, and market access. Fact number 5. The central bank justifies this decentralized storage with a clear principle: ensuring access to the reserves even in the event of a crisis, while keeping close ties to major market centers. Gold isn't there to be admired. It has to remain available and mobilizable. Fact number 6. In the late 1990s, the framework began to change. In its own documents, the central bank explains that it wasn't until around 2000, when the last remnants of the old gold standard legal regime were removed from Switzerland's legal framework, that it became possible to take certain reserve management decisions. Fact number 7. The central bank carried out a major sales program, totaling 1,300 tons of gold, completed on March 30th, 2005. This episode marked the shift from a legacy stock to a modernized reserve management approach, implemented within a coordinated international framework. Fact number 8. In 2014, a popular initiative proposed requiring the Swiss National Bank to hold at least 20% of its assets in gold and to ban any future sales of that gold. Voters decided otherwise and rejected it by a wide margin. That vote sends a clear signal. Politically, Switzerland favored strategic flexibility over a rigid rule set in stone for the long term. Fact number 9. Gold can weigh very heavily on the Swiss National Bank's results. In fact, for the 2025 financial year, the SNB reported a valuation gain of 36.3 billion Swiss francs on its gold holdings. That figure captures a modern reality. Gold can act as a hedge, but it can also introduce significant accounting volatility from one year to the next. Fact number 10. Beyond the official reserves, gold also affects how Switzerland's economy is read. In an SNB economic note, the central bank explains that global demand for gold as a safe haven asset can distort key indicators of Switzerland's external sector, which means these figures must be interpreted with caution. In short, gold is both an asset and a statistical factor. In summary, Swiss gold is not a romantic relic. It is a deliberate choice for diversification, resilience, and credibility. In a future shaped by geopolitical uncertainty, economic fragmentation, and financial volatility, gold remains a strategic asset, but it has to be understood with nuance. It can protect, it can carry costs, and it can make balance sheets more sensitive to market swings.